What's going on, YouTube Nation? This is Dark Dividend. If you guys are new to my channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So here is a big topic that we need to discuss, and this is dividend traps. So the market's taken a huge hit. A lot of these stocks are taking a huge hit, and all of a sudden you see these high percentage on these stocks that give off monthly dividends or quarterly dividends. And make sure that you don't fall into these traps. So let's talk about these dividend traps that investors fall into or rookies fall into. I'll be honest with you, I did fall into one trap one time. I woke up and I did break even, so I was lucky, but you got to be careful. So what is a dividend trap or a value trap? So a value trap is what we call a dividend trap. It happens when investors are lured in by high dividend or large dividend yields. The end result is when the investor finds out the company was not such a great deal or buy after all. So basically you got conned or you got duped or you fell into a trap. So this is why I gave this PowerPoint lectures on my dividends. This is why I make videos. I show you how things are looking, if there's growth, if there's potential. Stocks I invest in. I mean, investing became a hobby with me. I want to make passive income. And I don't want to fall in these traps. So I'm posting you videos on stocks that I invest in and how things are looking and the potentials. This is why I make videos, so that you guys see how I'm doing and maybe you can develop your own philosophy or create your own philosophy or not fall into certain traps or get a wake-up call sometimes. So this is why I made this very important. So this can happen to anyone. You can be a very good experienced investor. You can get duped. It happens to a lot of people. So I'm going to provide some examples of you guys of certain stocks out there that you might want to avoid right now and show you in this PowerPoint lecture how to watch out for these stocks. So here's the first sign of the trap. It gives off a high yield. So a dividend yield is determined by taking the yearly dividend payment and dividing it by the stock price. Hence, if we have a company that pays $1 in dividends per year, the stock price is 50%. The dividend yield is 2%. I'm sorry, the stock price is $50. The dividend yield is 2%. Changes in the company's dividend policy and daily fluctuations in the stock price affect the yield. My source is on dividend.com. They gave an excellent example. Second side of a trap, how is it doing against its competitors? So when you Google search, if you look at certain things, is it competing against these guys? Is it winning? Is it losing? How are things looking? So when I look at a stock, I look at Zacks.com and see what they say. I did a review on Zacks.com. I'll put that in my description for you to check out. This is why I really like these guys. What is Motley Fool saying about the stock? They have excellent resources for you to look into a stock before you consider buying it. They'll tell you the up, down, right, and left, A, B, start basically on that stock. I'm kind of old school if you remember the Konami game, the Konami series. So they'll tell you everything about the stock. Is it worth it? Is it not? This is what people are saying. This is what's going on with the board of directors. Motley Fool is another excellent source. So they'll help you get out of those dividend traps. So what are people saying about the stock when you Google search it? So if you look at stocks I invest in, I'll give you an example. I invest in Wendy's. They're talking about all the potential, how it's doing against the S&P, the potential of it. Is Zacks is giving articles on it. Motley Fool's giving articles about it. So, they're talking about the V-shaped or the U-shaped, the comeback and everything. So this is what people are saying about these stocks. So, do your searching first before you make the call. Just because I make a lecture on it, you got to do some digging first before you determine if it's a good call. And any articles that are potentially about it that basically say that they're decreasing their dividends or increasing their dividends or stopping their dividends, that's a red flag. I put a big whoa there, so you got to be careful a little bit with these dividend traps. So that's my second sign. Third sign of the trap is how does it look on a graph? If you Google search something, how does it look? Is it decreasing? Is it going down? Is it going up? So you look at the articles, you start reading stuff that they're losing money, and then you start looking at the graph and seeing how it's doing against the S&P. Is it losing? Is it in line with it? Is it slowly moving up? Is there some growth? But if it keeps on falling, that's a red flag. So if you go like back 10 years, it was $20 a share, and now all of a sudden it's at $7. And now this is including if the market fixes itself, that's a problem. So that's something that you need to look into. So I always compare my stocks to see how they're doing against the S&P. So I think it's a great guideline to see how stocks are performing. I'm going to show you some examples of some of these stocks too as well. So make sure you're continuing to watch so I can give you some examples. Now here's another thing. Are hedge funds or mutual funds dropping it? So certain websites, pretty sure Zacks.com and a few other ones, it'll show you how many hedge funds or mutual funds have it and how many are dropping it. So if these hedge funds or mutual funds are start dropping the stock, that's a red flag and that's a bad sign, because people that do mutual funds are actively actively managed. So they're helping people out with their retirement or their 401ks. And if they're dropping the stock, that's a bad sign. That's something that should raise a red flag, so that you got to be careful with that as well. So you can see how many mutual funds it's in some of these websites too. So that's the important thing. Motley Fool, I'm pretty sure they have that in Zacks. Don't quote me on that, but it'll tell you how many mutual funds usually stocks are in. The other thing is on E-Trade. E-Trade tells me some information on these dividend traps as well to watch out. They'll tell me to buy or get rid of it. They'll tell me how everybody ranks other things before I make the call. And a lot of these websites will, again, tell you if these mutual funds start dropping it and how they're doing. Fourth sign of the trap. Dividends are decreasing. So one of the tips I always give, and when I give videos and reveal to you videos, is I show the dividend history. So is the dividend going up, or is it slowly going up, or is it going down? So that's a problem if you're investing in certain stocks. And it's one thing if they're stagnant, they're just like, oh, let's just give an example. BHK, that's a stock, it usually gives off 5 cents a share. That's a bond. It's one thing if it just stays at 0.05, for forever. But if or like a preferred stock fund or the ones that, PFF, PGX, some of those stocks out there. But it's one thing if they're stagnant. It's another thing if they're decreasing. So that's why I go to NASDAQ.com and search the history. So I just gave an example. A bond stock should provide stable income. It should be stagnant. They're not going to really increase. It's a bond. Bonds are good for passive income. Don't get me wrong. I know people that invest in bonds just for passive income, just for stable income. So I gave an example. For example, a share of a bond provides 5 cents a month. BHK is right around that. Dividend traps cause you to lose money on dividends each time. So for example, I'm in a stock. It gives off 10 cents a month for 3 months. Then it starts dipping, and it starts going to 7 cents a month for 3 months. And then all of a sudden you start going to 6 cents a month. You got a problem there. So if you didn't study the graph, if you didn't follow 1 or 2 or 3 or 4, 1, 2, or 3, and then you see the fourth sign, that's another red flag. So if you follow step 1 and study the graph and read articles and do your research, you won't get into that. But going to NASDAQ.com, that's always my X factor too, to see how things are going. So just for an example, just go on your computer, pause this video real quick. Right now, I'll give you about 3 seconds. Okay, so when you pause the video, just go search a stock. Just look at BND, like Vanguard BND. Just pause this video, look that up real quick, and you'll see its dividend history on NASDAQ.com. It's kind of stagnant a little bit. Maybe if the market takes a hit, it'll go a little bit down, but it's pretty stagnant. Or BHK, look that one up too. And all of a sudden you start seeing these other stocks that are problems, which I'll reveal. Here's the fifth sign. So here's a great example by Dividend.com, fifth side of the trap. The first step in your research should be check out in the payout ratio. Absolutely. The payout ratio is how much a company's net income is going into dividend payments. For example, if the company makes $1 million in profit this year and pays out $200,000 in dividends, payout ratio is 20%. Whoa. If the company makes the same amount but is paying out $2 million in dividends, the payout ratio is 200%. And the company is going into debt just to pay shareholders. A company that's paying out the most of what it takes in, or the more it takes in, will be unable to maintain the dividend for long and may be heading towards financial trouble. Whoa, red flags. So always look out for red flags. I don't care if you're dating, if you're looking for a job. Always assess. I'm a registered nurse. I always call it the assess. That's our first thing we always do as a nurse. If things aren't going well, or if you're a physician or nurse practitioner or physician assistant, you assess the patient. So you're assessing the stock before you make the call, basically. So that's one thing I always like to say. And how about this? The other thing too is, I'm not a financial advisor, but speaking with a financial advisor, he'll give you the real talk. He'll give you the business too. I'm not licensed, but I'm just giving you some tips to be a dividend investor. That's another referral that you should look into when you're actively managing your IRA or Roth IRA. Those guys can do the nooks and crannies and do all this for you, but they'll tell you the truth on those stocks too. So that's another referral that I recommend with your financial advisor. So here's an example that a Motley Fool gave of a stock. This is DDR Corp. I mean, Motley Fool's awesome website. I wish I had the money to invest in those guys. I'm not Warren Buffett, but Motley Fool's a great site. I think very highly of those guys. They give great articles. So here's an example. DDR Corp. It's a real estate investment trust or a REIT which specializes in shopping center properties. Red flag right there, shopping center properties. Why am I saying that? Well, how many shopping center places are closing? Red flag right there. So if you did research and stuff and read articles, that will help you out as well. So based on the current stock price, DDR yields more than 10.2%. However, REITs tend to have higher than average dividends. So let's look at some point of the indicators listed below. For one thing, DDR has a rather high level of debt. At the end of 2017, the company had $3.9 billion in debt, which is quite high for a REIT with a 2.7 market cap. In other words, debt makes up 60% of the company's total capitalization. For comparison, most solid REITs have debt to capitalization ratios of 40% or less. Furthermore, the company estimates its FFO at 0.15 cents for the third quarter, and its quarterly dividend rate is 0.19. The FFO payout ratio is 127%. Red flag. And if you look at year 2 of the chart, the DDR stock price, you'll notice a sharp decline. The simple explanation is the DDR has significant exposure to struggling and bankrupt retailers, such as H.H. Gregg and Toys R Us, and also suffered from the Puerto Rico hurricane in 2017. So some of the things that Motley Fool gave you an example of, I just said in my steps. Articles, okay, if you study the stock and all of a sudden it starts going down, search decreasing or increasing dividend on Google. I mean, the internet is a valuable resource. That's how you learn information. And, it's giving you red flags. And, these guys, Motley Fool, they always give great examples of why stocks are decreasing their dividends or why they're struggling. These guys give the business. Same with Zacks. So those are really good ones. And even on my E-Trade website with my stocks, they really tell me about how these stocks are doing and why I should avoid them or why I should buy into them. Here's another one. I just made a post to my Instagram account, so make sure you guys subscribe to my Instagram channel as well as my Facebook channel. So here's a pretty hot REIT that was out for a while. People made a lot of YouTube lectures on them. So here's Apple Hospitality REIT. Hospitality, red flag. Think about that right now with this, I can't say it, but it's the problem that's hitting the market right now. So they suspended their monthly dividends distributions. effective immediately, postpones all non-essential capital movement projects, and has recently drawn down to its credit facility and preserves cash to deal with its effects of the outbreak on its business. Apple gains 11% in the pre-market trading. All of Apple Hospitality's hotels remain open and operational. Each of the company's brands and third-party management companies has implemented cost elimination and efficiency initiatives at each of its hotels by reducing labor costs and tampering certain services and amenities. C's reducing its capital improvement program by $50 million for the year. Has $300 million on cash, on the other hand, and no scheduled debt maturities for the remainder of the year, and $34 million scheduled maturities in 2021. Red flag. Okay, so look at this. $20 right around here. About $4 right now. It's about $4 a share. So it's been going down even when the market was doing really well. That's a red flag. And you're getting articles discussing it. The daily snapshot. This is just, of how the stock's doing. Percent off a 52-week high, negative 46.98%. Look at this, 52-week high and low, very volatile. This is on March 25th, 2:24 p.m. Open price. Look at this, it's down. It's not really recovering very well. So here's another example, Capitella Finance. A lot of people have lectures on them and saying, hey, buy these. I'm in a few groups, investing groups on Facebook, and I just read that and I just shake my hand. Look at that dividend yield, 30.57%. That's ridiculous. That's just crazy. $3.27. That's terrible right now. And even with the market doing well, I don't expect them doing very well. So, and I'm going to provide more examples of some of these stocks out there and go from there. Look at the dividend yield, 30.57%. Is that not a red flag or what? Now, there's one thing, like EPR Properties, it's giving off a high dividend yield, or Royal Caribbean and CCL because of I can't say it, but it's causing a big problem. And that's a big issue. So, but this one, it may recover slowly. If you're a day trader and like to sell and buy and stuff, you might want to consider it, because maybe you'll get a profit once it gets back up. I don't see it being at $3.27, but it could be maybe $5. So if you want to take the risk, go ahead. But I'm avoiding Capitella Finance like you wouldn't believe it. Here's its history. 2017, 13 cents a share on January. Then all of a sudden, October 2017, 13 cents to 8 cents. Ouch. And it's been continuously 8 cents. They're holding on an arm and a leg. I would stay away from that. And this is what Zacks is telling me right now, an Apple Hospitality rate to sell. Not good. And then here's another thing that Zach says. Wall Street expects a year-over decline in earnings and lower revenues when Prospect Capital resorts for the quarter ended in December 2019. It's widely known the consensus outlook is important in gauging the company's earnings picture. A powerful factor that could impact its near-term stock price is how the actual results compare to these estimates. The stock might move higher if these key numbers top expectations. The upcoming earnings report, on the other hand, if they miss, the stock may move lower. While management's discussion of business conditions and earnings will mostly determine the sustainability of the immediate price change and future earnings expectations, it is worth having a handicapping insight the odds of a possible EPS surprise. The estimate, this business development company is expected to post quarterly earnings of 0.18 per share in its upcoming report, which represents a year change of negative 18.2%. So, thank you guys for watching this video. Make sure you study your stocks before you make a call on a purchase. Remember, money makes money, but you don't want to lose money. So, this isn't, buying Browns tickets. You don't want to lose your money and, be miserable and stuff. So that's one thing. So bonds are better than decreasing stocks. You'll get more out of your money with consistent income versus decreasing income. So if you buy a bond like BHK or something, that's a symbol. It's like 5 cents a share or something like that. In the long run, you might get more than Capital Finance. So, they're usually pretty stagnant. I have, two bonds that are kind of like junk bonds. They'll go up, down, right, and left, but they're somewhat volatile. But I need to get that in my money machine on my dividend portfolio on my M1 Finance account. So I put those guys in there over Capital Finance. Get out of here. I don't want to deal with that. Those guys are Prospect Capital. So make sure you subscribe and hit the notification bell so you don't miss future videos. Make sure you watch my stock analysis videos so you can check out some hot stocks to buy. Those are in my honest opinion. Again, I'm not a financial advisor, but make sure you subscribe and hit the notification bell so you don't miss future videos. Thank you.